how much can you qualify for if you make X amount of income? I get this question all the time, and the hard part is it's hard to calculate something accurate because there's so many different parameters. So today I wanted to go over differences between 3% down, 10% down, and 20% down within conventional programs. And believe it or not, depending on the income you make for the year, depending on how much income you make, within the conventional programs, there are also additional loan programs that help people that are under a certain income limit. But for simplicity's sake, I kind of wanted to keep everything simple, keep it at like a 720 credit score, you know, 3% down payment, 10% down payment, 20% down, just to show you how different the payment's going to be on something like this. Now, when you start mixing in the different credit scores, that changes everything. When you start mixing in the amount of income you make, that also changes everything. But again, for simplicity's sake, if I were to keep everything similar across the board, and we use a $600,000 loan amount, and I'm looking at a 3% down program versus a 10% down program versus a 20% down program, of course, the 20% down program is going to have the lowest payment because there's no mortgage insurance and your loan amount is smaller, right? But we still want to compare because the main thing I wanted to show you was not only could your interest rate be better depending on your down payment amount, but the mortgage insurance, that's even a bigger hit to you is the mortgage insurance every month for not having 20% down. You could have 3% down, and depending on what your credit score is, you could pay something like this for mortgage insurance. You could pay maybe $242 a month for mortgage insurance versus somebody that puts a larger down payment might only pay about $135 a month for mortgage insurance, maybe even less. And mortgage insurance, what they're gonna do is they're gonna give you a quote, or they're gonna qualify you on mortgage insurance based on not just your down payment, but your credit score. So I'll give you an example. If you had a 719 credit score and your neighbor had a 720 credit score, even if you have the same income and the same down payment, believe it or not, there's going to be a difference in the amount of mortgage insurance you pay per month. So, you know, every time I talk about talking to a loan officer to get your numbers right, it's so much more important than I think a lot of people understand, because you could have the same income as your neighbor, but you guys are going to qualify for two different things. You could have the same credit score as your neighbor, and you guys still might qualify for different things depending on the income or the amount of debt each person has. So as we go through these examples, you're going to notice, of course, the 20% has no mortgage insurance because of the large down payment. And if you look at the payment here for the 20%, if you add in, and we keep the property taxes the same for this example at $125 a month, and we keep the home insurance at $20 a month, and for this particular example, the home insurance might look a little cheaper because we're going to base this off of a townhouse or a condo, which means the townhouse or the condo might have or will have a maintenance fee or association fee. So I'm going to throw in all those numbers to look exactly the same. This is just for calculation purposes. This is not an actual quote. So again, depending on what your credit score is, depending on your down payment, the interest rate's going to change. But for simplicity's sake, let's use 6% across the board, and let's look at the numbers. And you're gonna see that the total payment from the 3% down and the 10% down is still pretty different. It's over $350, right? Over $350 a month difference, just because of the down payment and the mortgage insurance. And this is keeping the interest rate the same, right? So if you just look at the mortgage insurance difference, you're paying over $100 a month just because of the mortgage insurance. And keep in mind, if two people both wanted to put 3% down, but one person had a 680 credit score and the other person had a 720 credit score, the difference is huge. I mean, it's so much bigger. If I had to guess, I would say maybe $200-300 difference a month just for mortgage insurance. And a lot of times, that's why when people say, well, I make good money and I can qualify, but they don't qualify for as much as they want to qualify for, it might be something like the down payment amount, or it might be the credit score. Now, the best way to, I guess, combat something like this is work on your credit, right? The higher your credit score on the different tier levels, the better your mortgage insurance is going to be. That means if you don't have a large down payment, it's still okay, because you're gonna get a better rate for mortgage insurance. You're gonna get a better rate for interest rates. And believe it or not, there's so many easy ways to increase your credit score in the short term, whether it's manipulating your balances on your credit cards by keeping them under a certain usage rate. Usually you hear people say don't go over 30% of your credit limit. A lot of times paying down the balance and doing something like a rapid rescore, depending on what lender you're using or what credit agency you're using, you can always try to update the score as fast as possible. I know a lot of people bring up authorized user accounts. There's so many different ways where you can increase your score to make sure you're in the best position possible. But the question is, where do you stand right now? Do you need help doing that? Because the more time you give the lender to fix your credit or increase your credit or whatever it is, the better your chances of success will be. If you have any questions on these calculations, let me know. Again, this was for simplicity's sake, so everything was pretty generic, but I hope I gave you a visual into what really happens when we work on different numbers and why the variance between qualifications are there. Because again, you might have the same type of program, but within the program, like conventional loans, there are different conventional loans that you might qualify for depending on credit score, your income, so many different variables. I hope this helped you out today, and I look forward to working with you soon.